Hey everyone, David Coe at the Core Real Estate Group. Hey, with the first week of December finally here, we're going to take a look at where we are at the end of November. We finally got some stats on both Los Angeles and Orange County real estate markets, so let's dive in. But before we look at real estate, we're going to start off by looking at the mortgage interest rates and, more importantly, how the correlation between the 30-year mortgage rate and the 10-year treasury seem to overlap. So this first graph here is I'm going to put this full screen. This is the 30-year average mortgage rate, which you can see as of last week, November the 27th, is right about 6.81%, which seems to be what we're seeing in the marketplace. When we look at this compared and contrasted against the 10-year treasury, you can see how these two graphs look very similar, right? So as the treasury rate goes down, mortgage rates seem to follow, right? So back in December here, when we were at 3.79%, when we look at interest rates, they were down here kind of in the mid sixes. And then as the treasury got up to, it looks like 4.7% in April, you can see mortgage rates followed, right around May the 2nd, up to 7.22%. And then, with some really bad unemployment, which from a real estate perspective, we like it when unemployment goes up a little bit, not too much, a little bit. All of a sudden, the 10-year treasury fell down to almost 3.6%, and mortgage rates followed, getting down almost to that 5.99% that we're all desperately waiting to see. But unemployment then started to tick back down a little bit. 10-year treasury went off. We're now looking at treasury rates post-election. The election was right around here. November the 5th was Tuesday. They immediately went down, then skyrocketed the next day, and interest rates seemed to follow. But you can see the treasury has been falling, and as of Friday, it's at 4.18%. So the theory is that mortgage rates will generally follow. Mortgage rates probably have, maybe a 15 to 20 basis point drop in them for the month of December, which could put us at, right around the mid sixes, which when you do look at mortgage interest rates historically, the mid sixes is about where we have been, right? If you look at, back in let's look at the 70s, rates were in the sevens and then started to climb as that decade went out, got crazy high in the early 80s with inflation. We look at the 80s, it was coming down 10 point, in the high nines. This is right around, where we bought our first home, was somewhere in this range right through here. 93, 90s were all kind of in the sevens. It did dip down in the 6% range every now and then, but it's mostly in the sevens. In the 2000, rates started coming down. We started seeing rates in the fives, in the sixes. And then, of course, in the 2000, post the Great Recession, rates got down, into the threes and the fours. And then, of course, during COVID is where we got this 2.79%. So when you look at where rates are right now, we're actually pretty low historically to where they've been. But if you look at recent history, and certainly recency bias comes into play here, we're higher than where we were all the way through the 2000s. And, right around this time frame is when most people, if they didn't buy a house at this time frame, they refinanced. And we have a whole generation of mortgages that are going to be in this, kind of 2 to 3% range that will take, probably 15 to 20 years before all those loans either start to mature, get paid off, or those homes get sold. So this is how we're looking at the impact on our real estate market. Once again, the blue line is LA County. The red line is Orange County. And we're looking first at closed sales. You can see in November, closed sales are starting to drop. Now, this is somewhat seasonal. If we look out, usually our lowest number of recorded sales is always in January. January of last year, you can see where those numbers were. There's a bit of an uptick in January of 2024, but more than likely for January of 2025, we're going to be somewhere down probably where we were at the beginning of this year in 2024. And then when we look at how this is impacting inventory levels, Days on market is actually staying pretty flat, right? We had a bit of a bump in, in the fall or late summer, but it seems to have kind of stabilized here, October, November. Average time on market about 20 days in LA County, 17 days in Orange County. And actual month supply is starting to drop a little bit, which may seem kind of counterintuitive that we have a decrease in the number of closed transactions. When you look at pending sales, pending sales just plummeted in November. There wasn't a lot of homes that went into the market right now. So why would we have a drop in month supply? Well, we're also seeing a dip in where the new active listings are coming. I think new listings, you can see right through here. I think a lot of people are probably just waiting to see what happened with the election, putting off decisions until January. So we really expect this number to spike back in January, February, which again is somewhat, seasonal, right? If we look at last year, December of 2023 through January, there was a huge increase in the number of homes available for sale. So more than likely, we'll see that happening in January, which means if you are a buyer or a seller, we're probably in a descending rate environment, and we're probably in an ascending supply environment. And then lastly, when we look at sales prices, you can see prices have kind of stabilized. If anything, they've come off of the highs that we had in May and June of this year. In Orange County, we got up to 1.2 million as the median price for a home. LA County was just about 920. And then we can see here in November, it's dropped, roughly 2 or 3% in LA County, and probably the same in Orange County as well. So overall, what we're looking at, again, is probably a descending rate environment, rates somewhere in the, mid sixes. I think we're going to see an increase in supply January, February. And prices seem to have stabilized. And I think, with an increase in houses coming on, I kind of think this is where prices will be probably mostly through 2025. We might get another little, peak up somewhere in the, kind of late spring, early summer. But more than likely, prices are going to stay where they're at unless there's some huge, event that happens and we do get into a bigger recession than what most people are predicting. So anyway, I hope this information was helpful for you. Of course, if you want to know how this information pertains to your situation, we would love to spend some time, talk about your situation, and help you put together a game plan to take advantage of what's happening in the market. So David Coe, the Core Real Estate Group, I hope you found this video helpful, and I hope to talk to you soon.